Hi everyone, we're just making sure that we've got EDF and Rob from CCS available. We'll be with you in a second. Hi, sorry everybody, just a couple of technical problems. We'll be with you in a sec. Hi Rob, can you hear me?
Good afternoon, guys. Can you hear me?
Yeah, can hear you now. Thank you.
Perfect. Guys, all participants, apologies for a few technical difficulties there, but we're there. So, good afternoon. Thank you for your time. We do really appreciate it. We hope you find this session. Just before we do start, just a few housekeeping rules. We are in an office today, so we are not expecting any fire drill. If we do, we'll obviously have to abort, but we'll pick it up at a later date. So keen to do this. In terms of hosting, Lauren will manage the technicalities in terms of placing people on mute, etc. But just to let you know, this is being recorded. You will have an opportunity to ask questions as we go throughout, and I think just with the opportunity, with the questions, just please try to make them quite generic, really, not specific yourselves, because what we'll do, we'll pick up these offline. It's really difficult to answer in a really wide forum. There's quite a lot of attendees today, which is really encouraging. but we will collate and we're happy to kind of pick these up offline. Just to reiterate that this is about non-energy costs only, so please make the distinction between energy costs, which is obviously the commodity, and non-energy costs. So this will be just about non-energy costs, how they're reconciled, and then how you see them on your invoices. For commodity, obviously what we will do, commodity reconciliations, we'll pick this up at a later date, and we will have a future webinar just based on that, just to discuss a little bit more detail. And just as a reminder, the reconciliations for commodity is generally for variable baskets. Today's webinar will be a series of educational pieces, obviously kicking off with non-energy costs, which is playing an ever-increasing portion of our final delivered price. And I'm delighted to be joined by Pete, who is EDF CCS Strategic Account Manager. Pete will be going through the webinar. A lot of them will be driving the slides, but Pete will provide you with the content. As I say, any questions that you do have, please let us know, and we'll pick them up. Pete.
Cool. Thank you very much, Rob. Good afternoon, everybody. Thanks for inviting us along, and I think Rob's covered all the main sort of admin intros, but I've set out a brief agenda as to what we want to cover today. Hoping to do about 20 to 30 minutes of slides and content to leave then some time for questions. And we have received a few in advance, which we very much hope the content we prepared will cover. We're happy to review those at the end, and as Rob said, anything that comes up throughout the session, we're happy to pick up at the end. So as I think it's a quick run through, yes, as Rob said, I'm Pete Fear, Strategic Account Manager, so I'm responsible for the overarching relationship between EDF and CCS at a framework level. Within today's session, going to sort of talk around non-energy costs, which a number of you will have seen reconciliations for appear on recent bills. So what we're really looking to cover off, as the agenda suggests, is really the context for why non-energy costs are present, what they are, what they mean, sort of what contextually as a part of your cost these contribute to the overall pence per kilowatt hour you pay, how we forecast those costs and how we reconcile those costs. So essentially, because they're not all known in advance, they're quite a tricky one to manage, as hopefully I'll explain and run through. To then sort of when they appear on your bills, and then just to wrap up as an associated part of non-energy costs, really the targeted charger review and what changes that's made to the presentation of some of your costs, some of your non-energy costs, most specifically transmission and distribution, but also a little bit on BSUOS as well. At the end of that, we've got some question and answer time at the end, just to go through, say, anything that arises from the call. My caveat for the call, as I start to go through, as an industry, we are extremely acronym heavy, so I will do my best to avoid using abbreviations, although I will slip into some, for which I apologise in advance. So I'll try and make this as clear as possible, and hopefully I'll articulate it correctly. So looking at why we need non-energy costs, essentially, there are a range of costs that all contribute to ensuring that and supporting the delivery of power from both large-scale power stations of all different types and more distributed generation of smaller types through our large transmission network. So where it's scaled up, transmitted and around the country via the large overhead pylons, where that's then broken down and taken through different distribution networks right up to the point of our sort of businesses, offices, homes, schools, and everything in between. Lauren, if you just click on one, there should be a few boxes that pop up that just sort of articulate that principally non-energy costs are in line to do these sort of three things. It's firstly supporting low carbon generation. So there are a number of sort of incentives which support helping improve the source of our generation to move away from fossil fuels and to a lower carbon, not renewable only, lower carbon future. We need to make sure that supply and demand needs are met. So it's a massive task for National Grid to make sure that they are always, every second or every day, matching as closely as possible the level of supply and demand, essentially keeping the lights on and keeping the grid balanced. And then efficient delivery of electricity. So we've seen really huge changes over the last couple of decades in the way that our energy system works. Historically, we used to be a nation which was sort of served by, comparatively a much smaller set of very large scale generations, a number of which were sort of fossil fuel led. We now move to a point where we've got a huge amount more renewables, a lot more sort of what we class as decentralized generation, feeding onto both the transmission and distribution network directly. So we need to make sure that the networks we need to operate are efficient and upgraded and maintained to deliver the power we need. We can skip on a slide, Lauren. So I just wanted to take you through, I think, the key non-energy costs. There are a few more referred to, and this is where I come my caveat of acronyms in the industry. It becomes sort of obvious, but I'll take you through the main non-energy costs as they appear and how they contribute into your bills and at what point of the process they become relevant. So first off, we start from left to right. There are three sort of high-level non-energy costs which are designed to support decarbonisation and balancing of the grid. So taking those in order, we have the capacity market supplier charge, which is essentially supporting new capacity, but also making sure that there is sufficient capacity in place and available in the event of the peaks, sort of highest peak demands on the grid, which typically happens over winter weekday peaks. So Monday to Friday, 4 to 7, between November and February is generally when we see the highest level of demand on the grid. So what that scheme does is it ensures that there is specific money available to make generators available and where necessary need them to operate on a short-term basis to help out with those extreme peaks, which we simply don't see all year round. So there has to be specific provision made to make sure that we can keep supply available when it's needed. So that's quite a specific and quite sort of focused charge, as well as, we talk about capacity on the grid more generally, serving different generations and also demand needs. The next one down is the renewables obligation. So this is actually a historic scheme, so it's no longer open for new applications. But historically, large generators, large renewable generators, could apply for a subsidy called the RO, the renewables obligation, which gave investors a fixed payment to support any sort of every megawatt hour of production. So it gave generators the security of a sort of like a fixed price. And that was really helpful in getting a number of renewables projects underway. The scheme is now closed, but when the scheme was open, it issued contracts or agreements that were anywhere up to sort of 20 to 25 years in duration. So whilst you can't add new sites into the renewables obligation, the scheme still needs to cover the costs of those assets which were created and delivered under it. Now, while that one is closed, that's now been replaced by the contract for difference. So the contract for difference is, and the difference in itself between that and the renewables obligation is the CFD covers low carbon generation rather than just renewables only. So low carbon can include, for example, nuclear, which is from a zero carbon perspective, but obviously won't be classed as renewable. So what the contract for difference does, and it's pertinent to some of the reconciliations we've seen, the large credit reconciliations we've seen, is the contract for difference gives a fixed output price for any generator who enters onto the scheme, and that fixed price is honoured for the generator. And if the market outturns below that value, the value of the wholesale is topped up to meet the agreed strike price. If the market pays above, the difference is paid back. So use a really simple example. If a generator agreed a contract for difference of £100 a megawatt hour, they would be guaranteed to get £100 per megawatt hour of every megawatt hour of generation they contribute onto the grid. If the wholesale market was only paying £80 a megawatt hour, there would be a top-up payment of the £20 difference to ensure that generator was kept whole. and they were, their investment decision was supported. If, however, the wholesale market increased above that £100, they would pay the difference back. So if it was 120, they would still only get their £100 as committed to, and the difference would be paid back. And I'll cover this in a little bit more detail further on the slides, but what we've seen in the last, since that scheme was created, from probably 2015, 2016, when it was first created, it was increasingly becoming a cost. And as one of the few welcome byproducts of recent wholesale market pricing, where that wholesale cost have far exceeded the amount of the value of the CFDs that have been in the scheme, actually what's happened is that's become like a credit to customers. So where we originally forecasted it to be a cost, markets sort of took off and went crazy as they did. We've seen a lot more money come back into the scheme where we have a credit. So the next sort of two in the middle, TNUOS and DUOS, so transmission network use of system charges. So that's getting it from the power stations on through the high voltage transmission network, and then the distribution use of system charges, which is going from the grid supply points literally to sort of homes and businesses up to the point of your meter. So they are the cost of both maintaining the existing network and investing in new networks to support new demand needs. And I think one of the really important things to consider when we think about transmission and distribution is that as we move towards a zero carbon future, and we very clearly have some quite stringent 2050 targets, what we are looking at is that when we talk about decarbonisation, we largely mean move a lot of our demand towards zero carbon power rather than, say, gas. So the level of power demand, we think by 2050 is going to at least double from where it was in 2019 levels. So there's going to be a huge amount more power needed as we move towards electrified heating, electrified transport, and we move away from traditional sort of supplementary gas networks. So there's a key time of change for both of those areas. And finally, on the right, for sort of homes and businesses, but I think sort of at the bottom end of the journey, if you like. For CCS, again, another one that rolls off the tongue, balancing services use of system charge. So this is where National Grid have to essentially make sure they're balancing supply and demand exactly for every second, every millisecond of every day, to make sure that there are given sort of profiles of consumption, but when it's generally hotter, we tend to have more sort of air conditioning load. When it's colder, and in the winter, we have more lighting, more heating. And if there are particular events that happen, which mean we're all sat glued to the TV watching a World Cup final or a coronation, domestic demand changes and profiles change. But also we have to look at, with varied generation types now, we have an increased amount of renewables capacity in the UK, which is great. So when the sun shines and the wind blows, we have the option to have a huge proportion of our energy generation coming from renewable sources. Unfortunately, that generation is intermittent, and where it's not linked up to batteries, it can drop off quite quickly when the wind drops or the sun doesn't shine. So we have to bring on board sort of more intermittent generation, such as sort of gas, and occasionally has been the case, some coal-fired power stations historically, to bring the sort of make sure that the level of generation is there to meet demand. And sometimes, if there is too much generation on the grid, that bizarrely includes the grid having to pay some generators to turn off or to not be able to utilise it, or if the generation is in a part of the country where it can't be utilised fully. But they're all things that we're trying to address as an industry. The final one, feed-in tariff. This is a smaller scale version of the renewables obligation I mentioned before. This is also a closed scheme, but that pays for sort of smaller scale, where people can potentially put solar PV on domestic properties or small businesses. That feed-in tariff was available. And again, schemes would be running for some period of time, but you can't enter it as a new. So they're the sort of 7 main non-energy costs. So if we flick on to the next slide, Lauren, just to give you a bit of context as to how much that makes up of your cost. So this is this is very much an averaged view. It will depend very much on what sort of wholesale price has been secured, and that will vary slightly basket to basket within the framework. But I think broadly speaking, we see that non-energy costs make up around 30% of an average bill, with transmission and distribution making up probably a reasonable chunk of that, followed by renewables obligation. But you see also on this slide there are some sort of little lightning strikes next to to each of the names, and that indicates just literally how variable, how volatile those costs can be, and how much they are linked to wider sort of wholesale market movements, particularly BSIOS and CFD, where the performance of the wholesale market can really drive the corresponding performance of the outturn of those costs and how they're calculated. I think one of the really tricky things to call out, and I'll come on to this actually, Brian, Lauren, we can go on to the next slide. One of the really tricky components with non-energy costs is that it's how we forecast and how we reconcile, because none of these costs can be fully known in advance. So we have to put in place a reference price, and we have to put in place a price which is going to be reflective of our best forward view of what these costs will be. But in terms of, I think one of the questions that actually came in advance was how do I currently pay for these costs? So this slide was just a bit of a view around every pence per kilowatt hour that you pay against includes all of these component parts, certainly for the top two boxes. So in addition to that wholesale cost, renewables obligation feed-in tariff and CFD, which predominantly support low carbon generation, and then the security and supply costs from balancing services use of system down to AAHDC, which I'll cover off, are embedded into your unit rates. And actually, you know, whilst we are able to talk about these in quite a detailed way in terms of and break them down and reconcile them for you as a framework member, these are all costs which are present, whether it's your domestic supply invoice at home, whether it's a small business, whether it's a fixed or a flex or a framework customer. These costs apply to everybody. They're just applied at different levels of granularity. And one of the things that is a benefit of the framework is that you have the option to have these passed through, or they are passed through, and they are therefore transparent, and then therefore you pay a very accurate and precise cost for them. So just there's a couple of additional costs that just appeared on this slide, which I'll cover off quickly, and they're not highlighted in bold because they are very, very marginal costs, but they do exist. So there is Elexon, who are essentially the administrator of the industry. So there is a very small cost which goes to them, and that's evenly charged across every supply, say residential, small business, large public sector. RCRC, residual cash flow reconciliation cash flow, that's a nice easy one, whoever named that, is linked to balancing services use of system, and it just ensures that the flow of continual reconciliation, half hour to half hour, hour to hour, day to day is balanced out, because we have to always look at what's happening now and what's happened historically. And then there is a very small subsidy which is built in essentially to support that, what was previously called the hydro levy. There is a very small cost that most parts of England and Wales pay to sort of help offset some of the extremely high distribution costs which are attracted in more rural areas, particularly of Scotland, where they have much less, historically have much less sort of developed infrastructure, certainly much less transmission, so much. And the last two, transmission and distribution, if you have a half hourly meter, you do have the option to have these passed through, but historically that would have meant 100% of your transmission costs being determined by triad reconciliations, for those of you that have had pass through, and distribution charges being largely driven by the red, amber, green time of use time bands. That's now changed, and I'll cover that on my slides around targeted charge review, but you still have an option for an element of pass through for those, so it's not all built into unit rates. and increasingly, as I'll cover off at the end of the pack, they're actually built into standing charges now. So if we could drop onto the next slide, Lauren. As I mentioned on the last slide, it's very difficult to know when for us to charge you accurately for these up front, because the costs aren't known until well after the period of delivery. I think at this point it's pertinent to note that the reconciliations which you've received on your most recent invoices, they relate to the April 21 to March 22 contract period. So you see from probably the table on the right hand side, there are a range of dates in which these costs are known, depending on how they are calculated and how they are validated and then how they are charged. And don't worry, on the next slide there's a little bit of a calendar which breaks this down a little bit more visually, but I think I wanted to just spell this out in terms of so if we think about the period of April 21 to March 22 for CMSC, I didn't know that cost until January this year for capacity market supplier charge. For SUOS, I get that quarterly, 3 months in arrears. CFD again was January this year, January 23 for the April 21 to March 22 period, and then renewables obligation and feed-in tariff were sort of like between June, July, August across or even into September. Transmission and distribution are monthly and annually respectively. But what I think the main purpose of this slide is to summarize is that I have to take a decision as a supplier to give you an accurate and representative reference price to put into your pence per kilowatt hour unit rates, within which I hope to recover a most reflective cost I can without knowing what the actual outturn will be. So the fact that I don't know those costs in advance means that there has to be a reconciliation, because the alternative would be I didn't charge you for it at all and then just sent you a massive bill sort of 12 months afterwards, which wouldn't be massively helpful to anybody sort of budgeting or accounting process. So a quick note about how we go about setting those reference prices. We use all of our relevant sort of industry insight and tracking of these schemes to model and forecast both all of the factors that could influence any one of these individual costs. We look at that, how those factors impact the nature of your portfolio, so right down to an NPAN level, the characteristics of how many half-hourly, non-half-hourly UMS, high voltage, low voltage sites you have, and we insert a reference price, which I say is very much designed to minimize the likelihood of any reconciliation, be it credit or debit, because we are aiming to make sure that you have as little of a reconciliation as possible. So Lauren, if we skip on to the next slide, I can talk about there maybe then the timings and how each of these have really worked out relative to the wholesale market conditions. So this is just a bit more of a visual representation of that previous slide, but in maybe a more easy to digest calendar format. If we look at that, this is modelled on sort of 22 and 23 calendar years. So for sure, as we say, works that's collated and reviewed every quarter, 3 months in arrears, but that is charged on a half-hour by half-hour basis. There is a published cost, and all of these costs are all based on published information, publicly available. We obviously summarise and condense that and validate that with CCS on your behalf, but there is data available and out there for all of these numbers. For SUOS, say for each half hour of every day, there is a determined balancing payment, and that can be hugely influenced by the relative wholesale cost. So where we've seen a surge in wholesale costs, as I mentioned before, that has potentially increased the cost of balancing times at peak demand. So where there's been a need to bring on short-term intermittent generation at times of peak, and when the wholesale costs have been very high, those generators could potentially have demanded or commanded a very high cost in order to respond. Similarly, where market conditions are lower or where wholesale markets reduce, they can correspondingly be lower. But they are probably the most frequently reconciled cost, albeit that they can fluctuate quite dramatically, which makes that extremely hard to forecast, and that can be down to weather, it can be down to demand, and it can also down to the external factors of the market. The renewables obligation and the feed-in tariff, I'll take those two together because they are of the five on the screen probably the easiest ones. I say easiest. They probably have the fewest amount of complexities. So with those schemes being closed, we generally have a view of the amount of eligible schemes, generation assets, both from that are entered into it. So really what impacts the level of that cost is how those assets perform. So like whilst we have an idea of what the commercials associated to it, they'll be very much dependent on how much predominantly solar or wind generation is sort of delivered within a given period as to how much of that scheme actually costs. You'll see that for some of them, there's like a shaded value and then a second value. There's like a provisional number, which is published, and then that's firmed up. These two are also subject to what we call mutualisation. So there is an overall scheme cost, and that scheme cost is split and shared out by every supplier in the market, and every supplier pays their proportionate share depending on their aggregate volume. So if one supplier had 50% of the market, they would take 50% of the overall cost of those schemes. If every supplier doesn't pay their bill, any bills that are non-settled, and this is one of the reasons we saw some smaller suppliers ultimately wind up in recent years, where we saw some supplier failures. Because you're paying for things retrospectively, if suppliers have either exited the market without paying their bill or found themselves in a position where they couldn't pay, that money is redistributed back across all suppliers that can pay, so the scheme costs are kept whole. But unfortunately, those other costs, as with other fees, get redistributed around. So we sometimes see several iterations of these costs where the mutualisation has had to take place. Contract for difference and capacity market. So CFD is to have a restep. Just go back to the top. Basuos was largely a cost for the 21 to 22 period. FIT and RO largely balanced each other out because the projections were more in line with where they needed to be. The biggest contributor, and you will have seen this for those of you who've seen those line items on your invoices, there was a significant credit for the contract for difference. And that's essentially because, as I alluded to earlier in the presentation, the CFD scheme, contract for difference scheme, entered into contracts with a number of generators at a strike price, so the price that they're agreed, which was reflective of the market conditions or a forward view of the market conditions when those agreements were made. So, and I'm happy to use the example of Hinkley Point C, which has a CFD in place. It's obviously not operating yet, but when it does, that will receive a strike price of £92.50 a megawatt hour. So again, just to recap, that means that for every megawatt produced, there'll be £92.50 paid per megawatt hour for that production. If the market's paying £72.50, that will get topped up. If it's paying £112.50, there'll be £10 paid back. So, sorry, get my maths right, 112 would be £20 going back. So, but the difference is where we've seen the wholesale market really, see some super excessive highs. What that's meant is that those generators were all receiving an income far above what their strike price was. So the scheme has actually become a source of revenue rather than a cost for that period where we went into it, and I say we and the industry went into the April 21 to March 22 period thinking that it could be a cost of around £8 a megawatt hour. It actually turned out to be a negative value for that whole period, which is why you've seen such a significant credit value, and that's overall ensured that the total value of your reconciliations has been a credit. Obviously, as we've moved into the 22 period and again into 23, we've revised down the forecasted cost or credit impact of those. So we are looking to ensure that the likelihood of that's been big reconciliations have been reduced. And finally, the capacity market, generally speaking, that was a small credit. And I think what we've seen is that demand recovery overall, demand is recovering in a post-COVID world, but it's not back up to where it potentially was. And I think we also saw over the last winter, we generally had sort of milder conditions. We generally had more favourable sort of or less strain on the grid, so we hit fewer times of absolute peak demand. And I think what we also saw is that nationally, as a country, we responded to the energy crisis by being far more aware of the impact and the cost of energy. So I think demand overall lowered. We saw in an instance where we had some particularly cold snaps. Historically, we would have seen that correlate to a real spike in demand and consumption. Actually, what we found is that last winter, more people chose to put another jumper on rather than whack the thermostat up another couple of degrees. And that as an aggregate effect reduced the overall demand. But that's just one example of how demand's been lower. So there was less call on the capacity market. So that was that's sort of how I've tried to capture there in those first few slides, just around what the main non-energy costs are, where we put them in your pricing, what they represent, and then how we reconcile them. I've got two more slides actually, just on targeted charge review, and then I'm keen to sort of open up the opportunity for any questions. For transmission, distribution, and BSUOS, there have been some quite significant changes in the methodology, particularly for transmission and distribution. So you may have heard or seen reference to TCR. So this is the targeted charge review, and historically we've seen BSUOS charges or distribution charges largely guided by the red, amber, green units, which were quite intensively focused on ensuring that there was quite a hefty premium associated to any energy used weekday peak. So Monday to Friday, 4 till 7. You would have seen that if you could avoid using energy at that period of time, it was obviously much more advantageous commercially. What that also meant was that people who had the ability to load manage or shift could benefit from making energy savings. Similarly, with transmission costs, 100% of the transmission cost was determined by what we call triad calculations. So your individual performance for half-hourly meters at the 3 highest peaks of demand over winter. So when we get to March, the grid looked back and say the 3 highest points of demand were the 1st of Feb, the 1st of Jan, and the 1st of December, between 4 and half 4 or 5 and half 5. And your consumption is overlaid onto that those times of highest demand, multiplied by your regional costs, and your cost is determined. And what that meant is that actually people who had the ability to effectively load manage, typically sort of more sophisticated, larger scale energy users, because the pricing signals were encouraging them to do so, were avoiding large parts of cost, in some instances avoiding costs altogether. And there was nothing wrong with that, there was nothing illegal with it, it was just the fact that they were taking advantage of the way the system was designed. So what Ofgem sort of said is actually it's not wholly fair that not everybody is paying a proportionate cost for what they're using. If you are a large energy user, you should pay a fair and proportionate fixed cost according to the size of your supply. So in April 22, they made some changes to the distribution charges, so BSUOS, and what they did was they significantly reduced the value of the red, amber, and green units that were charged for half hourly. So and they transferred some of those costs into a much higher fixed standing charge. So from April last year, you would have seen a much bigger distribution standing charge and a much lower set of red, amber, green rates. What it's also meant is that from April 23 this year, transmission costs have moved away from triad calculations, not entirely, but largely. So at least 90% of your costs for transmission are now fixed. And there are some areas, it varies by area of the country, but if you're in the north of the country, generally speaking, 100% of your costs are now likely to be fixed. If you're in the south or southeast, there's a component which could be up to 10%, which is still determined by triads. And this is probably quite a detailed point, which I can pick up offline and we can provide some more guidance on, but depending on what region you are. But I think the main message is that there's a huge amount more costs which are now fixed, so there's less opportunity to avoid them. So everybody pays a proportionate share. So the main focus has been in the interest of balance and fairness and even recovery of these costs. That to touch on very quickly, those costs are determined by the size of your supply, essentially. So there's an element of proportionality. It's not a blanket, but what it means is that irrespective of largely now region, or there's a consistent approach to, if you are a low voltage half hourly supply deemed to be in band 2 because you have a kVA between 80 and 120, that's a consistent cost. So somebody who has a much bigger agreed supply capacity and forecast volume will pay their proportionately more than somebody with a much smaller one. And those costs are determined based on the historic usage. So there's not the scope of the system to just say, actually, I'll just tweak my kVA and I'll put myself into a lower band. It's based on your historic consumption, so it's reflective of your actual use on the grid. So they're the two main ones, and the final bit I just mentioned now on BSUOS. So I've talked quite a bit about what BSUOS is, the Balancing Services Use of System charge. Historically, my wording on this slightly better, I think up to March 2023, BSUOS was 50% collected by generators and 50% by sort of you pay as an incoming levy. Actually, what that's now moved from is from April 23 is that's 100% is levied onto customers. So the BSUOS cost you will see has increased, but it's been taken off of the generator cost. So actually the wholesale cost is reduced by a proportionate amount. So it's what we call a zero-sum game, in the sense that this is not an additional cost. It's more like the two above, a balancing out of costs. So I'm just going to summarise that in my last slide, Lauren, and then I'll go into any Q&A. I'm not going to read all this out because it's really wordy, and I've probably gone a little bit over time that I intended to anyway. But I think that and there's probably a recap of some more of this as the whole webinar. We've really, these changes are in to reflect the fact that the grid works differently from how it was originally designed and how those charging structures were designed to incentivise behaviours. So there's been a much more of a levelling out, a much more of a fairness approach. And these are still big costs. They're sort of 25 to they have been as far as sort of like 20-ish% of cost, depending on which portfolio you're in. But there's still opportunity to save, albeit much reduced. It's probably summarised best for those two sort of summary points at the bottom. You now have sort of far significantly reduced opportunity to sort of make any cost avoidance from red, amber, green distribution charges or the historic triad reconciliations for transmission and distribution for transmission. But you will have seen the standing charges significantly increase, so these fixed cost items will be there. So that is the summary of the pack that I wanted to run through today. This is a hugely complex subject, and there's rabbit holes and that you could explore in each of those individual ones. But as a start point, I hope you found that useful and insightful as a guide to non-energy costs, where they come from, what they do, how they're charged, how they're reconciled, and some more context between those line items you would have seen on your recent bills. I'll move now, I think, as a final slide, Lauren, just to offer up any questions, and whilst we just check through for anything that's landed. I don't know if Rob, you've got any closing comments?
Yeah, thanks, Pete. I think to be fair, I think a lot of the content is also available on Club CCS as well. CCR specific webinars, if anyone wants more information about that. Club CCS has a raft of information, webinars, guidance, documents, etc. So if you don't already have access, please shout, we'll get you access. It's not something you can Google, but yeah, there's lots of information available on that, including a lot of the content we've covered today.
Yeah, absolutely. And if you without getting access, if you really quickly want to go to edfenergy.com/CCS, you get to the Club CCS welcome page and you can go from there. So we're just going to see if we've got any questions now, I think.
I can't see any that have come through.
Oh, neither can I.
And that's fine. You know, we'll welcome questions after the event as well. It's not a closed shop. Like we said, we're more than happy to do other educational webinars as well. So if somebody wants to understand a little bit more about a particular topic, we just felt this one was relevant just to the reconciliations that are landed on your invoicing. We hope you found it useful. I guess we'll just leave it one more minute for any questions if anyone wants to put any in. Otherwise, we'll close it. Okay, I think we'll leave it there then. Guys, thank you very much for your time. Pete, thank you very much for the content. Yeah, we'll close it there. This is recorded and we will get it shared with you guys as well. Many thanks.
Thank you, everybody.
Thank you. Bye.